Here we go. One step at a time, don't be living on the line.
This lesson is going to provide a brief introduction to free trade based on the principle of comparative advantage. We're going to learn how to illustrate the gains from free trade based on comparative advantage and a supply and demand diagram for a particular good that is traded between two countries. A basic economic concept in the study of international economics is that known as the principle of comparative advantage. We're going to start with the definition of what this principle relates to and discuss briefly how it applies to trade between nations. So the principle of comparative advantage basically says that whenever a country has a lower opportunity cost in the production of a particular good than a potential trading partner, the country should specialize in the production of that good in trade with other countries. Now that's just a long-winded way of saying that countries should specialize in the production of the goods that they can produce more cheaply than other countries. Now this is really the principle that guides trade between nations in almost every example we can identify in the global trading arena. Let's think, for example, about the market for consumer electronics in the United States. Let's start by assuming that America produces all of its own electronics domestically. We have the price of electronics and the quantity of electronics produced within the United States. And based on the laws of supply and demand, we'll have an upward sloping supply curve for electronics and a downward sloping demand curve for electronics. Consumers will want to buy more electronics as the price falls, and producers within the United States will want to supply more electronics as the price rises. Hence, without trade, there would be an equilibrium price of electronics in the United States determined by the intersection of the domestic supply and the domestic demand. So we're going to actually label these demand curves domestic, indicating that this is just the demand from American consumers, and domestic supply, indicating that this is just the supply of electronics produced by American electronics manufacturers. As most Americans know, not many electronics are actually manufactured in the United States today. Now, there are reasons for this, and it has to do with the principle of comparative advantage. But before we get to that, let's do some basic economic analysis of the closed market for electronics in the United States without trade. I'm going to shade the areas of consumer and producer surplus in two different colors. We'll shade consumer surplus in yellow. Recall from earlier lessons that consumer surplus represents the additional or extra benefit enjoyed by consumers of electronics who are willing to pay more than the actual equilibrium price of those electronics. So we can see that there are some consumers who would be willing to pay more than they actually have to, indicating that there is consumer surplus in the market for electronics in the United States. Now this, of course, is domestic consumer surplus. So I'll label that CS with little d for domestic consumer surplus. Producer surplus represents the additional welfare enjoyed by manufacturers of electronic goods who were willing and able to sell their electronics at a price lower than the actual equilibrium price. Producer surplus among American electronics producers, therefore, is the area below the domestic price of PE and above the domestic supply of S domestic. There's our producer surplus without trade. So both of these shaded areas now represent the total welfare in the market for U.S. electronics without international trade. So the next question is, well, what happens if the United States decides to allow for the import of electronic goods? First of all, we should ask the question, why trade? Why might the United States want to open its electronics market to trade with other countries? Let's identify a few reasons here. Well, first of all, the U.S. has a high-skilled workforce with lots of education. The U.S. is a high-wage country. Because of the high-skilled workforce and the well-educated workforce, people expect to earn high wages in the United States. In addition, the U.S. has a very high-tech manufacturing sector. The U.S. particularly excels at the production of high-tech capital goods and very expensive technologies such as airplanes and so on, medical research, scientific research, and so on. Generally speaking, the U.S. is not particularly good at producing electronic products. Now, not to say that it couldn't produce electronic products. The fact, however, though, is that the production of many electronics is relatively labor intensive If the US were to produce all of its own consumer electronics, the opportunity cost would be rather high. So the most important thing here is that the US has a high opportunity cost. Now, what is opportunity cost? This refers to what the country would be giving up in order to produce its own electronics. By producing its own electronics, the US would be giving up the production of all of the other high-tech goods that it could be producing, and the research and development it could be undertaking, the expensive capital equipment it could produce and sell to the rest of the world, the jumbo jets that it actually does manufacture. The opportunity cost of producing consumer electronics in the United States is high relative to some other countries. So that begs the question, well, where should consumer electronics be made? I think we all know where consumer electronics are made today. Overwhelmingly, they are manufactured in Asian countries, most notably China. Now, why is China a place where lots of consumer electronics are made? Well, let's look at some of the characteristics of the US workforce that may not be necessarily true for China. If we look at the skills of the workforce in China, China has a much larger pool of lower skilled labor. In addition, workers in China are willing to work for lower wages. In China, the workforce is not as high skilled. The wage rate that they're willing to work for is lower. And China has not developed the high tech capital that characterizes the US economy. The opportunity cost of manufacturing electronics in China is relatively low due to the low wages, the abundant workforce, and the ability of Chinese manufacturers to produce consumer electronics at a low opportunity cost. In other words, they're not giving up all of the high-tech goods and the research and the service sector jobs that could be provided if they had a higher skilled, higher educated, higher wage workforce. So let's make the assumption that most consumer electronics are going to be manufactured in China. So next we're going to examine the impact of trade with China on the market for consumer electronics in the United States. To show the impact of opening the US consumer electronics market to trade with China, we first must consider what will happen to the price of electronics when the United States begins to trade with China. The obvious answer to that question is that the price will fall. And in fact, that is what we're going to show happening here. But how do we show the price falling? Price can either fall in a market because of a decrease in the demand for a good or an increase in the supply of a good. By opening the country up to trade with China, it is the supply that will increase, which causes the price to fall for electronics. Not only will the supply of electronics increase, but the supply will also become much more elastic. How do we illustrate an elastic supply curve? To do so, we must show a supply curve for electronics that is nearly horizontal and much lower on our diagram, indicating that supply has actually increased. So I'm going to label this new supply curve supply world. China is not the only country that produces electronic goods, so we'll call it the supply world. It's the supply of electronics with trade. Notice that supply has increased and become more elastic, indicating that the United States consumers of electronics are not going to affect the price of electronics should their demand fall or rise. Notice that if the demand for electronics were to shift to the left, the world price of electronics, of PW, barely changes. The US is one out of around 200 countries demanding electronics. They will not have a huge impact on the price should US demand fall. Likewise, if demand were to increase and shift to the right, there is no change or relatively little change in the price of electronics. The US are price takers as consumers of electronics in the world. So now we see that there's a world supply curve that is further to the right or below the domestic supply curve and far more elastic, meaning that the US are going to pay the world price if they allow trade with the rest of the world. The price is no longer determined only by domestic supply and demand. Let's determine now the effect that this increased world supply resulting from free trade with China will have on the domestic market for electronics in the United States. The first thing to notice is that there is a dramatic increase in the quantity demanded of consumer electronics. At a price of PW, the domestic quantity demanded will be much greater. More electronics will be bought at a lower price due to free trade. However, what will happen to the domestic quantity supplied? To answer that question, we must look at the relationship between PW and the domestic supply. If we go over to the domestic supply curve from PW, we can see that domestic electronics manufacturers in the United States will be willing and able to supply a much smaller quantity of electronics now that the price has fallen to PW. Competition has driven the price down. Competition from Chinese manufacturers with their much lower opportunity cost of manufacturing electronics has driven the price down, and as a result, we have seen a movement along the domestic supply curve from a quantity of QE to a quantity of QS. So that begs the question, if only QS electronics are being produced, yet QD are being demanded, where will the difference between QS and QD come from? And the answer is imports. The quantity of electronics imported will be QD minus QS. The rectangle below PW and between QS and QD therefore now represents the revenues of Chinese electronics manufacturers enjoyed thanks to free trade with the United States. So the price of PW times the quantity imported represents Chinese producer revenue. This is the total amount spent by American consumers on imported Chinese electronics. Let's look now at the impact that free trade will have on consumer and producer surplus in the United States. First thing to point out is that consumer surplus increases dramatically. Since consumers are buying a much larger quantity of consumer electronics and they're paying a much lower price, the yellow triangle representing domestic consumer surplus has increased dramatically in size. American electronics consumers are far better off with free trade with China than they were in a closed economy without free trade. The U.S. consumer is benefiting from China's comparative advantage in electronics manufacturing. There is a net gain in consumer surplus. But what about American electronics producers? What happened to them? Well, it's not a good picture for American electronics producers. We can see that the lower price of PW drastically reduces both the quantity of electronics that they will be manufacturing and the level of producer surplus accompanying that quantity. The new area of producer surplus is a much smaller triangle now. So we can see the consumers have increased the level of consumer surplus dramatically, producer surplus has decreased, and the purple rectangle, as we said, is Chinese revenue. This will go to the producers of electronics in China from American consumers. So what happened? The domestic quantity demanded increased, the price fell, increase in the quantity demanded, but quantity supplied decreased. Chinese producers receive a large chunk of revenue. Consumer surplus is a much larger area. Domestic producer surplus is much smaller. But to conclude, we must evaluate the impact of free trade with China on total welfare in the United States. Total welfare, as has been explained earlier in the course, equals the sum of consumer surplus and producer surplus in any given market. In the U.S. market for consumer electronics, we can see that there has been a net increase in consumer and producer surplus of the area that I am now shading in green. Yes, producers of electronics are worse off. There's no doubt about that. Domestic producers, that is. But the consumers of electronics are so much better off that the loss of producer surplus is offset by an increase in consumer surplus. The green triangle represents the increase in total welfare resulting from trade. Essentially, the green triangle is a way of illustrating the gains from trade enjoyed by the United States, resulting from its decision to open its market for consumer electronics with China. There are losers from free trade. Clearly, that is the domestic producers of electronics in the United States. But there are winners from free trade as well. The American electronics consumer has enjoyed a massive increase in his welfare. In addition, the Chinese producers are now receiving revenues that they would not have received without free trade with the United States. Later in this same unit, we'll examine how that Chinese revenue from its trade with the United States can actually come back to benefit the United States in the end, as Chinese consumers begin demanding more goods manufactured in the United States, perhaps goods that the United States itself has a comparative advantage in. So this lesson introduced the principle of comparative advantage, which has to do with the opportunity cost of production of a particular good, and explains how countries should specialize in the goods for which they have lower opportunity costs. We then looked at an example, the US market for electronics, in which American producers clearly do not have a comparative advantage. Yet once the country opens that market to trade with China, there is a net gain in total welfare, which we call the gains from trade. Producers are made worse off, but the consumers in the United States experience such a large increase in consumer surplus that overall the market is more efficient and there is more welfare.